Hello and welcome to episode 371 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, we're back. We had a bit of a break.
Yep, well, you did. I was very much still here holding the fort while half the Money to the Masses team seemed to disappear and have a week of well-deserved, I have to say. But yes, we are back and reunited, so it's good to be back. And actually, it's quite nice having a small break over the Jubilee weekend because you feel rejuvenated to come back on the show. And we've had some nice messages from people saying that they missed us during the breaks. That's always nice to hear.
Yeah, it's lovely to be back. And actually, you guys, the listeners, came good while we were away and did exactly what we asked of you, which was to leave some lovely positive reviews. So, Damien, if you don't mind, I'm going to read out a couple of those reviews now. The first one is from Will Pither, and he said, "Have been listening to this podcast for some time, occasionally at double speed, to get that drum and bass theme tune." Now, before I read the rest of that, what he means there, we mentioned a few weeks back that Damien likes to listen to the podcast at double speed because he often has to check to make sure everything's okay with it. And he realised that our newish theme tune that we've got, if you listen to it at double speed, it's a banging drum and bass tune.
It's an amazing drum and bass tune, in fact. So that was a bit of an in-joke there.
And so Will goes on, "The content is always pertinent, especially enjoy the contributions from the team and the guests. Damien and Andy offer a balanced view supported by the Money to the Masses website for more detailed information. And as a Leicester fan, I will overlook the sporadic football mentions."
Now, often I will give out a Money to the Masses mug for people whose reviews we read out. And there's a small part of me that feels like the subtle dig at the end, there won't be a mug going out. But at the same time, the review showed such dedication to listening to the podcast because not only did they pick up the drum and bass reference, but they also picked up the fact that I'm obviously a Spurs fan and Leicester beat us to a title many moons ago. So this person clearly does listen to the podcast on a regular basis. So do get in touch with Lauren at moneytothemasses.com and you can claim a free Money to the Masses mug.
Okay, and so before we get on to what we'll be covering in this week's podcast, I'll do one more review. And this is from Baz Suffolk 9. "Great show. I learned so much from the team. Thanks." So nice and simple. Baz, if that was you, do email Lauren at moneytothemasses.com to claim your Money to the Masses mug. Right, so what have we got coming up on this week's show?
Just before I mention what's on this week's show, as an aside, I don't know if people will have noticed that Amazon announced a stock split in the last week or so, which I bring up because I think in the last podcast, I gave an example that if Amazon wanted to entice investors with smaller amounts of money, they could do a stock split. And then what happened days later, it was announced. So I feel like some kind of Nostradamus in the investing world. So I just wanted to mention
you were almost there as well, because you give an example of a 10-1 stock split, and I think it's a 20-1 stock.
Yeah, I will have to up my game on that part. So what's on this week's podcast? I want to do a piece on bonds, and in particular bond duration. Now, I'm conscious that on episode 365 of this podcast, I talked about index-linked gilt, and I mentioned about duration at the very end of that podcast because it's an important concept to understand. And going back through past episodes, I realised I don't think I've ever covered duration. Andy even looked through the back catalogue. So I'm going to talk about it because it's a very important concept that most people don't really understand. And it will help explain why some popular funds, including things like the Vanguard Life Strategy funds, have done so poorly year to date. And then after that, Laura is coming onto the show. We're going to talk about a development in the credit reporting space. So everybody has a credit report with the three main credit rating agencies, but there's a new development that's happened, almost got under the radar, and I've not seen much mentioned about it regarding affordability monitoring that is happening by these agencies. So it's something that you will all want to be aware of because it will impact how you manage your finances going forward. And the last piece is relating to a development in the buy now, pay later space, which involves Apple. But I also want to discuss a little bit around that and why people need to be careful.
Great. So let's start with bond duration then. There's a concept that people need to get their heads around, and you're going to kind of explain it.
Yeah, so you don't need to understand duration as such if you're going to invest in bonds, because people tend to buy bond funds and don't really engage with it. but it does help explain why bond funds might underperform or outperform their peers, or why they might not perform in line with your expectations. So it is a concept that I think people should try and understand. Now, just to recap, a bond is an investment, but effectively it's a loan, typically to a government or a company. So what will happen is you may invest a lump sum, just to use a round number, £1,000, and in return for that £1,000, you will get regular interest payments, which are called coupons, perhaps every year, every 6 months. The terms are set in stone in the details of the bond. And then at the end of the bond's term, known as the maturity date, you will get your original principal back. So the original £1,000 that I mentioned in that example. So that is how a bond works. Now, a bond is essentially a loan to a company. As I said, they're called corporate bonds, but you do get things like gilts, which are loans to the UK government, but you also get things like treasuries, which are loans to the US government, and bonds, which are loans to the German government. So these are all different types of bonds, and they're relatively easy to understand because when you invest in them, you will know the terms of that bond outset. Now, if you take a really simple example like that one I said that was £1,000 initial investment, so you loan £1,000 to a company, for example, and you don't get any interest payments and you just get back your principal at the very end of that term, and let's say it's 10 years. Now, that wouldn't be a great investment because you're just getting your money back after 10 years and inflation's had an impact, but you can understand very quickly at which point you'll get repaid your money, and that is the 10-year period. Now, as I mentioned, you will typically get interest payments on a bond at set intervals. These are known as coupons, and they compensate you for the investment risk, because obviously if you loan money to anybody, be it a company or a government, then there is a risk that you might not get the money back because they might default, for example. So different bonds may have their payments structured in different ways, different times, different amounts. But the point at which you get back your money, so your break-even point, will therefore vary from the 10 years in the first example I gave where there was no interest payments, because you're getting money along the way. So if you were getting coupon payments, say every 6 months, compensated you for that investment risk, and then you got that principal at the end, your break-even point won't be at year 10, it will be much earlier. Now, typically the coupons are static, they're fixed, which is why you hear the term fixed income when people talk about bonds. It doesn't have to be the case, but often it is. Now, the length of time at which you break even is called the bond's duration. Now, as I mentioned, that is different to the maturity term because of those income payments that you get along the way. So your break-even point will be earlier, and so that is the duration. Now, park that for 1 second. Now, let's think of an example where you've got a bond that lasts 20 years and there's an annual payment that you will receive, and it will be the same for each of those years. Now, it means that as interest rates rise in an economy, which typically happens when inflation's going up, because if you remember, the central bank will start to raise interest rates to control that, then you have the issue that the fixed income payments going forward become less attractive, because if interest rates are rising, then the rate that you've got on your bond that isn't going to change won't be that exciting. So let's say you had a coupon that was only giving you 0.5% a year. Well, we've seen interest rates in the economy start going up, then your bond isn't that attractive anymore, because there'll be others that will be issued by, say, the government, which will give a higher rate because they're going to have to try and attract people to lend them money. So your issue with a lower coupon won't be as attractive. And so what happens is then if you try to sell that, because when you invest in a bond, you don't have to just invest in bonds at the outset, they can be traded as well. And so the value of your bond, if you want to sell it during the term, will start to fall if interest rates are going up. Conversely, if interest rates are falling in the economy, then your bond might look quite good against the ones that are now being issued. So therefore, there'll be a demand for your bond, and therefore the price might go up. So you actually get back more than you paid, for example, in it, even though you've held it for a period of time. So the price for that bond might start to increase. Obviously, if you hold a bond to its maturity date, then the price will start to converge towards what that final principal amount is. So like I said on that example, a loan of £1,000, as you get towards the end, you're only going to get £1,000 back because you've had all the coupons already been paid out to whoever was holding the bond at that point. Then the price will converge back to that principal amount. So you can see why when interest rates are rising and inflation's going up, bonds aren't particularly attractive, so people start to sell them. But in a world where maybe inflation's falling or interest rates are going down, maybe there's an economic downturn, then bonds start to become attractive because interest rates are likely to fall. As a result, typically of in the UK, the Bank of England cutting interest rates to try and stimulate the economy. And of course, don't forget that if you have inflation going forward, the purchasing power of the money that you're getting each year that is fixed is worth less as well over time. So that makes them less attractive unless there's some kind of indexation going on with your particular issue. Now, why duration is particularly interesting for bond investors is because it influences how much the price of a bond goes up or down in relation to the ups and down in interest rates. So for every 1% increase or decrease you have in interest rates, so just think about the broad economy. So when interest rates are generally rising, so when the Bank of England raises the base rate, you will have noticed savings rates go up, also the mortgage rates go up, the amount that banks will lend to each other, that interest rate goes up. So the interest rates in the economy start to rise. So for every 1% increase or decrease in interest rates, a bond's price will change by roughly 1% in the opposite direction for every year of duration that it has. So if a bond has a duration of 5 years, then if interest rates rise by 1%, the bond price will fall by 5%. And of course, the opposite is true. And bond funds hold hundreds and hundreds of different types of bonds within them. There isn't just one. So managers go and pick bonds from all sorts of companies out there and they make a corporate bond fund. Now that combination of different types of bonds mean that the overall fund will have its own duration. And so as interest rates move and the expectations of them change, then the value of the bonds within that fund will also change with respect to their duration, and that will make the value of the fund go up and down. Now, this is important in a world like we are now, where this year we've seen interest rates start going up. Central banks are raising interest rates, and expectations of further rate increases are going up. So what it means that we've seen that rise in interest rates, based on what I've just told you, if you had a bond with a long duration, then its value is going to fall far more than a bond with a short duration. Or in other words, a bond where the payback period is much further in the future because the payments, including the principal and coupon, are much further off in the future, then that's going to be impacted more than a bond where the payments are front loaded. So it might have a shorter maturity date, but you might actually just have more of the payments sooner rather than later. That makes sense because you are getting more of your money up front. And so when you look at 2022 in particular, you will notice that some bond funds have fared way better than others, even in the downturn. So even though nearly every bond fund will be lower and falling in value as bond markets have hit this slump, and don't forget when yields rise, the value of the bonds themselves falls, they move in opposite directions. We've seen this slump in bond markets. Those bonds or those bond funds with longer durations have fared the worst and have been really hammered, while those funds with shorter durations have fared much better. And to give you an idea, what do I mean by short and long? Now, a short duration on a fund, a corporate bond fund, would have a duration measured in years, which would be probably somewhere around about 3, whereas something that is longer duration has a measurement of about 15 to 20 years, much longer. And you can find the duration of any fund by looking at the fund's fact sheet. Unfortunately, there is no easy way to find the fund duration for any fund that you want to buy because it's not something that's widely quoted. I don't know if it's because people don't understand it or investors just aren't that interested. But after listening to what I've just explained, it's a relatively simple concept, but it's useful because in an environment like we are now, where interest rates are rising, that's bad for bonds. Then if you have funds that have a shorter duration, then it's going to have less of an impact. They're going to fall less. And if you look at the funds that have shorter durations, that's what we've seen in 2022. Now, some funds do have the word short dated or short duration in their fund names, but very few of them. Similarly, you get some funds that have long duration or long dated in their fund name, but you should never really buy a fund based on its name. Now, you will notice that index-linked gilt funds, as I mentioned in podcast 365, have done badly this year. And that is because as a group, they tend to have a much longer duration because of their design. They have longer maturities, and the way that their index linking works, so the payments actually do start to increase over time. The money you get back, the break even, is much further in the future. So when interest rates rise, then the value of the fund falls at a much bigger rate than funds with shorter duration. Of course, if we entered a world where interest rates are slashed, or expectations of interest rates are that they're going to fall, then long duration funds will do really well. And we've seen periods in 2022 where suddenly expectations in markets have changed. The market started to price in less interest rate rises, and then we've seen longer duration funds do really well for like a week or so. So listening to this, people should be able to then decide if they are going to invest in bonds as a diversifier, then they could, depend on the environment, look at duration to hopefully amplify any returns that they might have. But it also can amplify the losses. And as an interesting aside, I mentioned Vanguard Life Strategy earlier on. And when I've looked at the performance of those funds this year, and they have struggled because obviously equity markets have been down and bonds have fallen. But Vanguard, when you look at a lot of their funds, they have long dated, so funds with long duration. But it seems to me, when I look at the numbers as well, that the life strategy funds contain bonds that have longer duration in them. So that's why the bond element of those funds hasn't performed very well at all in this period of rising interest rates and expectations that rates are going to go up.
So on that then, if you've invested in a bond fund and having listened to this podcast, you're now thinking, oh, okay, I understand it. Let's go and have a look at that duration of that bond fund that I bought. Are there bond funds out there that just have a scattergun approach in terms of the duration? Do they all stick to sort of short-term durations, long-term, or is it, how do you find out the average?
So that's where you look at the fund fact sheet, because it will tell you what the average duration of the fund is.
Right.
Because like you say, they do buy a mix. Some will have a focus on being shorter, some will have a focus on being longer duration, others are just based on what the manager views. Now, duration is a measure of interest rate risk, and bond managers are always managing duration. It's one of the things that they're constantly trying to manage because it dictates how their fund will perform in an environment. And this piece I'm doing now was inspired by a piece of research for 80/20 investor members. And what I was highlighting, that if we were suddenly to get a rally in bonds, so yields start to fall and bonds start behaving like they did before this year, and so we suddenly had a rally in bonds rather than the slump we've seen so far in 2022, because that's always a possibility. How could you take advantage of that sudden turnaround if you really wanted to? And the answer would be to go and find bonds with longer duration. So the things that have been beaten up in the first half of this year would be the ones that would likely fare better if we suddenly had an aggressive turnaround. So the message is that bonds don't have to be boring.
Okay, so let's move on to the next piece of the podcast then. And we're going to be talking about affordability on credit scoring. Now, this is something that's come about, Damien, recently. What happened?
So the reason this actually became a topic on the podcast is a listener got in touch about an issue they were having in securing credit, and they had a good credit rating and they checked all their various different credit reports, couldn't see anything on there. But then they did start to notice something called an affordability score that appeared on their credit reports with various agencies, and then began asking the question of what this is and is this impacting their ability to get credit. So what we're going to do is bring Laura onto the show again. So Laura obviously writes about our credit stuff, among other things. So she's really our credit expert. So Laura, welcome to the show. What is going on with the credit reporting agencies and this affordability testing that seems to have crept under the radar?
Yeah, so I think people are generally used to the idea of affordability tests when you're applying for a mortgage. Like that is something that has been going on for a long time, that lenders are not just looking at your past financial behaviour, but are also looking at how much you can realistically afford to pay on your mortgage and what will happen if your circumstances change over time or if interest rates go up. this now seems to be migrating also into other types of lending. And as you say, with a couple of the credit reference agencies, they're now also, alongside your usual credit score and credit rating, they're also offering this affordability rating. And what that does is it provides a way of potential lenders being able to quite quickly see if you're likely to be able to afford to repay the loan, and how likely you are to default on the loan as well. So this tends to fall into two categories. And so I think what has happened with the listener who wrote in, they've used the Money Saving Expert Credit Club to access their Experian report. And what that does is it takes the information that you provide when you join the club, when you fill in the application, which includes things like your income, the number of dependents you have, and any kind of big borrowing that you're already doing. And from that information, it comes up with this affordability score. And that's kind of actually quite a rough estimate of how much your spending is, what kind of extra debt you could afford to take on. And that can then be viewed by lenders. And in the case of this listener, although they've got a high credit score and high credit rating, because presumably they've been quite responsible and sensible with their financial behaviour in the past, they're falling down with the affordability score. And they were concerned naturally about how this score has been derived and how it's now being used, and they're struggling to get credit. The issue is that in order to get like an accurate affordability score, you need to provide Experian via the credit club or directly with Experian with permission to view your bank account through the open banking mechanism. With Experian, what it does is it creates what they call an affordability passport, which provides a snapshot of their income, their monthly spending, and how much is basically left over at the end of the month, as well as other forms of debt and just general spending habits. And then that is used to provide a more accurate affordability ranking or assessment.
So what we're getting to then is the world has changed, and it hasn't been with any great fanfare, that people are used to the idea of looking at their credit reports, making sure in the lead up to applying for credit that they behave in a certain way to make sure when the lenders do this affordability assessment at the point of the application that they got a greater chance of being accepted. Then through things like open banking, which just for listeners to know, that's when you link up your bank accounts, credit cards, whatever it may be, via technology, whether it's third-party apps or in the case that you've mentioned here with Experian, that gives them read-only access to information on the way you use your money. That sort of stuff now seems to be being pulled together that can be used in affordability assessments. So at the moment, which credit agencies have started to create some form of affordability scoring?
So at the moment, certainly we have it with Experian, and that's also accessible through the Money Saving Expert Credit Club. It's also a feature of ClearScore, although they only do it through giving permission and going through this open banking mechanism, rather than it being this estimate of your affordability score. So it's not something that's been rolled out widely across all of the credit reference agencies, although I suspect that it's going to become something that is more prevalent. And I think you're right that it is going to, in effect, change the way that people are viewing their finances and viewing their spending. And perhaps in the same way as when you know you're going to be applying for a mortgage, your broker may well advise you to have a few months of having more sensible spending, that you may be more mindful if you're going to know that you're going to likely to apply for a loan, car finance, or another big level of borrowing, that you will again modify your spending and perhaps cut out some of the unnecessary extra spending.
So the reason why I really wanted us to talk about this on the podcast, because this is a significant change, I think, because it's something that had passed us by, we hadn't noticed. There's no, like I said, big fanfare that's gone on in the media. And actually some of the agencies have only recently launched this. So in this year, so 2022, where they've started to create this affordability scoring. Now, Now, going forward, it only makes sense that this is going to be used by lenders potentially. Don't forget, we had things with buy now, pay later services that are starting to report transactions on your credit reports. So there is a shift towards more information being made available to lenders. And to give people an analogy, if you imagine the world we've been in has been like when you're driving along the motorway or along the roads, when you're trying not to speed. So the speed cameras come up, you know where they're going to be, and you're bombing along the road, ignoring the speed limits, and then you slow down at the point of the cameras, go through, don't get a ticket, and then off you go, start bombing down the road again. But now we have those average speed checks. So if you're driving along the M1, you'll know what I mean. So they'll work out what your average speed is over a period of time, and if you exceed the average, then you'll get a ticket. So technology's helped them do that now. So you have to be a more responsible driver the whole journey or that portion of it, and not just speed up and down. Now, this is what this affordability check-in is a parallel in my mind. So what you're going to end up doing is having to live your life like you're in an average speed camera zone and behave in a way that you're being assessed almost continually, rather than just at the point you apply for credit when you hit that speed camera. And that means that we're all going to start to have a shift in mindset, that we're going to have to make sure we are living within our means, and maybe at any point could be assessed or be applying for credit, that we're going to have to live like that, not just every 2 years when we remortgage or every 5 years when we remortgage. So that's what I want people to take away from this part of the podcast, is there is this shift now, or now we're going to probably all have to be living in a slightly different way than we did before, because this seems to be the direction of travel.
It's certainly something of a double-edged sword that, on the one hand, it's clearly designed to stop people from getting into unmanageable levels of debt. So in that respect, it is a positive development. On the flip side of that, there is the pressure to provide that open banking access to kind of reveal more about your finances to these agencies. And some people aren't going to feel that comfortable with doing that. Otherwise, you're left vulnerable to these scores that are really a rough estimate of what your affordability is. And that can make it more difficult to access finance if you've been downgraded, perhaps unfairly, which is what had happened with the listener who wrote in.
And I know there'll be people listening to this now suddenly panicking about the information they've given these agencies access to via open banking. Of course, I'm joining dots here, but if you look in the news, certain budgeting apps have been acquired by credit rating agencies as well. And so that gives more information potentially available to these agencies. So that kind of thing is likely to continue. But don't forget, via open banking, every 3 months, so every 90 days, you have to renew that access. You get asked whether you want an app or a service to still have that information on you. So you have control over that. So going forward, we might have to be a little bit more mindful of who we give access to that open banking information to. So thank you for coming on the show, Laura, as ever. I think that was incredibly useful and something for people to take away and act upon.
Okay, so let's move on to the final piece of the podcast then. And we mentioned buy now, pay later. And actually, our final piece of the podcast talks about buy now, pay later because Apple have entered the space, and they've created a product which is primarily for US users right now, but it may impact UK users in the future. So Damien, you've got a piece on this.
Yeah, so I don't have the definitive answers on all of this to do with Apple, but to give you the bones of it, this week, Apple had one of its fanfare presentations where it announced changes to software. You can now do amazing things like edit a text message. So they stopped the world, do a big presentation roadshow to say you can now edit a text message, which feels like something that should have been happening about 5-10 years ago. But there were other interesting points to their announcement. And the one that did grab probably a few headlines in the money press in the UK was the announcement that Apple are going to launch a buy now, pay later service in the US. Now, this is part of one of their future updates they're going to do on iOS. And for buy now, pay later providers in the UK, this was big news because whenever Apple enters a space, it's a bit like when Google enter an industry, it will really tend to shake it up. Now, the service is going to be called Apple Pay Later, and it will work with MasterCard's network. So it will allow iPhone and Mac users in the US to pay for purchases in 4 installments over 6 weeks without being charged interest or other fees. And it will also be built into Apple Wallet, so it can be used at any location that supports Apple Pay. That means both online and in stores. So ignoring all the other kind of PR fanfare, this isn't the first time that Apple has launched into financial products. So they have allowed consumers to pay in installments for their gadgets, so things like iPhones and Macs for 7 years. And they also did partner with Goldman Sachs and MasterCard to launch an Apple Card back in 2019 for US customers that had no fees. So it is an interesting development. Now, the reason that I mention it on the podcast, because there will be people that might be intrigued about it, but buy now, pay later is going to become easier. So there'll be people who haven't been intrigued by the likes of Klarna, or there may be people who have used them, but now when you use Apple Pay like I do, then you are going to be offered that option to be able to use the service. So it's not even going to be you're going to go looking for it. That worries me. I won't deny it, because there was a piece of research that came out this week that was conducted by Citizens Advice, and it showed that more than 2 in 5 recent buy now pay later customers ended up borrowing money to make their repayments, and that included using things like credit cards, bank overdrafts, or borrowing from friends or family, or even a personal loan, a payday loan, or a guarantor loan. And in the age group between 18 to 34, then just over half, so 51%, had used some form of borrowing to repay it. Now, that's the majority. So in that age group, you can say the majority of people who have used buy now, pay later have ended up borrowing money, often through things like credit cards, in order to repay it. So the argument that buy now, pay later empowers consumers to be able to spread the cost of things that doesn't encourage them or get them into debt, in my view, doesn't hold true. As this research shows, if you start using those services, then the odds are around about 50-50 that you're going to end up probably borrowing money to be able to repay that. So that's the first warning.
Yeah, it just seems to be kicking the can further down the road.
But what also makes Apple's entry into the market interesting is they acquired a UK-based credit checking startup called Credit Kudos in March this year. Now, presumably this development will come to the UK in terms of the buy now, pay later service from Apple. But what Credit Kudos did, it used machine learning to create an alternative to traditional credit scoring, which if you were to join dots, and I don't know this is going to happen, but it could suggest that Apple may look to expand its lending services in some way. And at the time it was acquired, Credit Kudos aimed to make affordable credit more widely available and assist in faster lending decisions by looking at alternative measures to assess the credit risk of individuals for companies, which included at the time things like rental apps, brokers and other fintech firms. Now, going back to Laura's piece, you start joining the dots here, and this direction of travel that we're seeing in the world of finance is that we do really need to be mindful that these services are actually empowering lenders to have more information about us when they make decisions about whether they want to lend to us. So the piece is a quick FYI that this might be coming. My view that buy now, pay later services aren't great, and if you are tempted to use them, then it's perhaps a sign that you are living beyond your means. And the concern I have that a lot of people are using debt to repay them. Yes, some people are managing to not do that, but it's not a massive leap of faith to think that buy now, pay later, although it's supposedly going to become regulated in the future, but with services like Klarna going to be reporting transactions in the future to credit rating agencies, these services enable lenders to get more information and a bigger picture about you. So if you do use any of these sorts of services, then just be mindful of that fact going forward.
Yeah, it's an interesting piece, and sort of looking at it from my opinion, going back to Laura's piece about affordability assessments, and also with Klarna saying that they are going to be reporting buy now, pay later purchases to credit rating agencies, lenders could take this information and profile customers to think, well, these guys over here, they've accessed buy now, pay later. Potentially that might be a flag to say that they're living beyond their means. But there's another customer over here that is a similar profile but hasn't used it. To them, they may look at those and go, well, this customer over here is a lower risk to us. So we're not saying this is definitely happening.
No, it's a valid point, because don't forget that when people are profiling you, they are also in part making a judgment on your future borrowing behavior. So credit limits, how much money you have access to, all these things go into the mix, and there's no definitive way that they do it. It all goes into the mix. So anyway, it's a development that is very interesting, but something I think as listeners you should be mindful of the potential impacts of using buy now, pay later services.
Okay, so that's it. We're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's Damien@moneytothemasses.com. Don't forget to head over to to Instagram, and please do follow us on Instagram if you don't already. We're very, very close. In fact, we might have hit it to a very big number, which we're quite excited about. And if you haven't followed and you're on Instagram, there's no excuses.
Yeah, and just to add to that, I'm regularly doing pieces on Instagram that go and look at past content on the Money to the Masses podcast to tell you of clips to go and listen to. I'm cherry picking basically, but linking you directly to the bit in that past episode to listen to. So for example, this week I went back and looked at how now's a great time to get off the car finance merry-go-round and build wealth.
So that's it. Until next time.
Until next time.